Good Friday morning, Market Chameleons. Everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, D, good Friday morning, my friend.
Good morning, Will. Good morning, everyone. Let me share my screen. And I think today what we'll do is cover a tool that tracks the cost of an option strategy. Okay, so a lot of times when we look at strategies, and it could be a call spread, put spread. In this case, we're going to look at a straddle. We could look at it from different perspectives. We could track the implied volatility of a stock, but tracking the cost of it may give us a little bit more insights in it. And sometimes it's just easier to, you know, kind of understand your risk and reward potential looking at it from that perspective instead of implied volatility, because when you're looking at implied volatility, you kind of don't really know, well, what am I risking? How much premium am I paying for things? Is it, and, so this kind of looks at it from a different perspective. So let's take a look at it. We'll use SPY in our example. So if you type in the symbol up top in the search up here, you will come to this summary page, and on the left-hand side, you have this menu. You click on options, and we're going to go to this strategy benchmarks tab. And what this does is track or benchmarks the cost of different types of strategies, that are popular as you go down the line here. To trade or common. And we're going to click on this tab here, Straddle. And now what we have is this benchmark. And what the first one is tracking a 30-day at the money constant maturity. So 30-day constant maturity at the money straddle. If we go down, we also have the 60-day, you'll see 90-day, 120. So when we look at the straddle, well, how do we kind of like normalize or standardize so we could, understand it, over time and be able to even compare that cost to other things easily. So in this situation, and this is the description of a straddle, if you're buying an at the money 30-day call, buying an at the money 30-day put, and we convert that cost to the percent of the stock price. In other words, if it says 2.4% in our case, well, for every $1,000 worth of stock, it's like $24 in cost of a straddle. Okay, that's the way you would think about it. That how much premium am I paying relative to the stock price? Okay, so that's 2.4%. So if you had a stock that's $100, right, 2.4% is $2.40. So the cost of that straddle, buying call and put, is $2.40, meaning that the stock would have to move 2.4% in this case, up or down in 30 days to cover the cost of that straddle. That's where the buyer and seller, or the fair value, is break even. So now that we have that benchmark, well, what can we do with it? We kind of know what the cost of that is. And in SPY, how does that compare to history, right? So that's what we want to do, is say, okay, here it could be different in SPY, it could be different in Google, it could be different in Apple. So So is it on the high end, low end? Where is it relative to where it usually, is? Because it's straddle, it's not like a stock where, could appreciate forever. It's usually like around some kind of range. So then we could compare that to a longer term average, right? Like what's if we took the average of our observations over a year period, what is the cost? And that's what this is. 52-week average is 2.5%. So we could see that right now, relative to history, it's close to the average, a little bit below. Okay, that's what this is showing. It's a little bit below the average. And if we wanted just to see how much it changed on a day, right? Because one thing we track is just like a stock price, right? On the day, it's up $2.10. So we kind of get now an idea, what this reaction is from the trading. This here is the change showing us that on the day it declined by 0.1%. Okay, to 2.4. So that's really quickly where we can go and get a different perspective, than implied volatility, because here's a 30-day IV, 12.5. It is a number, that's a number. If you in implied volatility and SPY's implied volatility, is it high, low? You could see here it's in a moderate range, but this puts it in a more perspective in terms of cost, right? Because you can't really take that and in your head figure out, well, 12.5, what would the straddle cost? So this makes it a little bit easier. Now, we also would want to see, well, from a historical perspective, how high or low has it gotten and where are we relative to that? And that's what this graph is. This graph, just like a stock chart, shows the cost over a 1-year period. So this dotted red line is the average of all of these observations, and we could see how far away to the upside or downside it's moved historically in the last year away from the average, right? If it was very close to the average, we would see these observations very close, but we see some spikes up here, like way up here. To the downside, we've seen it, at least here I'm looking at as low as 1.9%. But this is a historical perspective of the cost of an option straddle in SPY if we look at it on a 30-day constant maturity. Just keep in mind, we need to define, which maturity or which expiration we're looking at. Now, of course, this is a benchmark because we don't always have a 30-day constant maturity. So what we do, just like the VIX, we use a formula to come up with a synthetic 30-day straddle based on the surrounding data, whatever the options that straddle, the expirations that straddle 30 days and the options surrounding that, the monies. And we could then go down the line and even look at it on the basis of like over time. So here in a 60-day maturity, we're also a little bit below the average, 3.4% versus 3.6. And this allows us to do a couple of things. Here we see that they're both below the historical average by nearly the same amount. But we also see what it would cost us to go from a 30-day to a 60-day, right? 1% more. So to move from a 30-day straddle to a 60-day, we're looking at a 1% more in cost, 1% premium, which from historical perspective, it's about a 1.6. I'm sorry, a 1.1 difference from 2.5 to 3.6. So that's something when you're looking at it, and trying to decide which way you're moving, or do you buy one versus selling one? Do you just move up to the further expiration, or do you stay in the near term? But those are things that you may want to analyze and look at it from a historical perspective to get a sense of, well, if I'm looking at if I'm looking at this particular strategy and I'm looking at straddles and I'm trying to determine where along the horizontal skew or horizontal time term structure should I be looking at, this kind of helps put things in that perspective. And then we could keep going down the line. Well, what if I went to 90 days? So from 90 days, we're adding, what's that, 0.9%, a little bit less than 1% to go from 60 days to 90 days, all right? And that's a little bit cheaper than historically at 1%. And let's see, to the 120, so to go from 90 to 120, right? So this is already going by more than right. So from 90 to 120, that's a 1% increase again. Okay, so it seems like almost for each 30 days you're adding another percent in cost, which seems close to that historical average. And again, here we see that how these performed in the past. So these are the graphs, and we could see where we are currently relative to the average, which is the dotted line, how far away. And we see historically, the high and low ranges that it moved away from that average. So this is a kind of quick way to say, I'm looking at a particular strategy, in SPY. In this case, we're looking at a straddle, and you needed something just to get a sense of, well, what am I paying? What are the costs here if I did it in this expiration? Because that would be the risk could, and where is it relative to history? Is it on the high end, the low end, and how did they even compare to other straddles if I look at different times to expiration? So I might end it here, not just so I'm not going to go to too many places, but it's the same concept kind of as we move to a different type of strategy, whether it's a strangle, a call spread, a put spread, and so in all these other ones, you'll define it right here. So let's say if you did a call spread, it would be buying on a 30-day constant maturity, not the money, and here selling a 5% out of the money, the cost of that. So that's the idea behind benchmarking the cost of strategies.
All right. Great job, D. We did have a poll out there today. 75% of the people are rooting for the Eagles on Sunday.
Go Eagles, yeah.
Yeah. So that's
from our
you voted. I'm voting for you too for the Birds. All right. So maybe it's around 80% now.
Okay. All right. Thanks.
All right, D. Great job as always. Nice webinar to end the week. Everyone have a safe trading day. Enjoy your weekend. I don't know if people are taking Monday off. It's always amazing that we don't either have a national holiday on Monday or have a game on Saturday. It's always hard to have a full Super Bowl for myself on Sunday. I'm usually dead by halftime.
Yeah, same here.
Yeah. All right, everybody. Have a great day. Trade in peace and have a great weekend. Enjoy the Super Bowl. Thanks, D.
Thanks, everyone. Stay